A few days ago, billionaire investor Jeremy Grantham went on The Diary of a CEO and warned that the U.S. stock market could fall by as much as 70%. And today, I'm buying Mastercard. Does that mean I think he's wrong? Not at all. The truth is, I don't know what's going to happen next, and neither does anyone else. That's exactly why I started this series. This is Decision Log. Every time I make a long-term investment, I record the decision before I know the outcome. No hindsight, no pretending I saw it coming. Just my thinking, exactly as it was on the day I invested. Maybe the market crashes. Maybe it keeps going higher. Either way, this video will always show exactly why I made this decision. So today, let me show you why I bought Mastercard. Before we continue, I'd like to make one thing clear. Everything you see on this channel is for educational and entertainment purposes only. I'm not a financial advisor. Nothing in these videos should be considered financial advice. Always do your own research and make your own investment decisions. On July 1st, 2026, I bought approximately $4,200 worth of Mastercard at an average price of $525 per share. This wasn't a trade. There isn't a short-term price target. This is a long-term investment built around a simple question. If I could own only a handful of businesses for the next decade, would Mastercard deserve one of those spots? For me, the answer was yes. But before buying any company, it has to pass my 3 investing rules. Rule 1. Is this a great business with a wide economic moat? When I invest, I don't start by looking at the stock chart. I start by understanding the business. Because in the long run, it's the business that drives the stock price. And the better I understand the business, the more confidence I'll have when the market goes through ups and downs. So the first question is simple. What exactly does Mastercard do? A lot of people think Mastercard is a credit card company, but that's not really accurate. Mastercard doesn't lend money. It doesn't charge interest when someone carries a balance. Instead, it operates one of the largest payment networks in the world. Here's what that means in simple terms. Every time you tap or swipe a Mastercard, whether you're buying groceries, booking a hotel, or shopping online, money moves between the cardholder, the merchant, the acquiring bank, and the issuing bank. Mastercard sits right in the middle, connecting everyone together and making sure the payment happens securely and in just a few seconds. For doing that, it earns a small fee on each transaction. One transaction doesn't make much money, but when billions of transactions happen every year, those small fees add up to an incredible business. Now, here's the part that really caught my attention. Mastercard doesn't just have one way of making money. It has 3 major revenue engines. The first is transaction processing and domestic assessments. This is the core of the business and its largest source of revenue. Simply put, the more people use Mastercard, the more money the company makes. The second is cross-border volume. Think about traveling overseas or buying something from another country. Those transactions typically generate higher fees, making this one of Mastercard's fastest-growing businesses. The third is value-added services. This includes fraud prevention, cybersecurity, data analytics, and consulting services for banks and businesses. These services have become an increasingly important part of the business, and they're growing even faster than the payment network itself. That combination is one of the reasons I chose Mastercard over Visa. I think both are outstanding companies. If you're looking for stability, Visa is hard to beat. But I wanted a little more long-term growth. Mastercard's faster-growing businesses gave me more confidence in where the company could be 10 years from now. Specifically, their double-digit expansion in value-added services, like cybersecurity and fraud prevention, gives them a distinct high-margin edge in data security that Visa's pure scale doesn't automatically replicate. Of course, a great story isn't enough. I also want to see the numbers support the business. Guru Focus is a great tool for me to research these information. When I looked at Mastercard's financials, I saw a company that has consistently grown its revenue, net income, operating cash flow, and free cash flow over many years. To me, that's exactly what I want to see. The business isn't just getting bigger, it's becoming more profitable and generating more cash along the way. I also checked a few quality metrics, like return on equity and the company's balance sheet, to make sure the business is financially healthy. Mastercard passed those checks comfortably. But there's one more thing I always look for: the economic moat. To me, this is one of the most important parts of analyzing a business. A company can have great revenue, strong profits, and healthy cash flow today. But if competitors can easily copy its business, those numbers may not last. That's why I always ask one more question. What protects this business from its competitors? One of the tools I often use is the Morningstar report in Robinhood. It gives me a quick overview of whether the company has a narrow, wide, or no economic moat. It's not the only source I use, but it's a great place to start. In Mastercard's case, its payment network is accepted by millions of merchants around the world. It has long-standing relationships with thousands of banks. Consumers already trust the brand. And the more people who use the network, the more valuable it becomes. That's what's called a network effect. It's incredibly difficult for a new competitor to build a payment network at this scale. That's why I believe Mastercard has a wide economic moat. For me, it clearly passes Rule 1. Rule 2. Is this a good time to buy? Finding a great business isn't enough. Even an amazing company can be a bad investment if you pay too much for it. So after deciding that I wanted to own Mastercard, the next question was simple. Is today a good time to buy? I don't try to buy at the absolute bottom. Nobody can do that consistently. Instead, I try to buy great businesses when they're trading below what I believe they're worth. After doing my valuation, I estimated Mastercard's intrinsic value to be around $620 per share. I bought my shares at $525. That's about 18% below my estimated value. For me, that provides a reasonable margin of safety. But valuation alone isn't enough. While I am strictly a long-term investor, I like to use technical analysis as a tactical tool to optimize my entry price and avoid catching a falling knife. So let's look at the weekly chart first. Here, Mastercard found support at a price level that had held up before. More importantly, it formed a bullish pin bar. To me, that's an early sign that selling pressure may be fading and buyers are beginning to step in. But I still didn't buy. Why? because I wanted one more piece of confirmation. So I switched to the daily chart. At the time, Mastercard was still trading below its 50-day moving average. That moving average had been acting like resistance. As long as the price stayed below it, I wasn't ready to invest. Then something changed. Mastercard broke above the 50-day moving average, and it did so with strong trading volume. That told me buyers were becoming more aggressive. Even then, I didn't rush in. I wanted to see whether the breakout would hold. Over the next 2 trading days, Mastercard stayed above the 50-day moving average. That gave me the confirmation I was looking for.
So, on July 1st, I bought my first position at $525. Could the stock still go lower? Absolutely. That's always possible. That's why I didn't invest everything at once. My long-term goal is to build this into about a $12,000 position, or roughly 10% of my portfolio. For now, I only invested about $4,200. If Mastercard falls further, and my investment thesis hasn't changed, I'll continue adding over time. I don't feel the need to buy my entire position in a single day. Patience is part of the strategy. Based on the valuation and the technical confirmation, Mastercard passed Rule 2. Rule 3. Exactly when will I sell? I think this is one of the most overlooked parts of investing. Most people spend all their time deciding what to buy and when to buy. Very few think about when they'll sell. For me, I want that answer before I invest a single dollar. For every long-term investment, I follow a simple framework I call TVO. T stands for thesis. This is the most important one. I'll only sell if the reason I bought the company no longer exists. For Mastercard, that could happen if its competitive advantage starts to weaken. If management consistently makes poor long-term decisions, or if the payments industry changes in a way that permanently hurts the business. As long as my original investment thesis is still intact, I'm happy to keep holding. V stands for value. Even great businesses can become too expensive. If Mastercard's stock price climbs far above what I believe it's worth, I'll consider trimming part of my position. Not because I think the company has become bad, but because the market may be offering me an opportunity to lock in gains and rebalance my portfolio. And O stands for opportunity. My money should always be working where I have the highest conviction. If I find another company with a much better risk-to-reward opportunity and I don't have enough cash available, I may reduce my Mastercard position and move that capital into the better opportunity. Those are the only 3 reasons I'll consider selling. Not because of scary headlines, not because the market has a bad week, and not because the stock price becomes more volatile. Owning great businesses takes patience. Sometimes the hardest decision is doing nothing at all. Based on my TVO framework, Mastercard passes Rule 3. Every investment has risks. Mastercard is no exception. Governments could introduce regulations that reduce transaction fees. Competition from new payment technologies could become stronger. Consumer spending can slow during economic downturns. Or I could simply be wrong about the company's long-term growth. None of these risks disappear because I like the business. The goal isn't to eliminate risk. It's to understand it and decide whether it's worth accepting. For me, the answer was yes. Could this investment lose money? Absolutely. The market owes me nothing. But that's not how I measure success. Success begins with making a thoughtful decision, following a consistent process, and giving that decision enough time to play out. Years from now, I'll come back to this video. Maybe this investment becomes one of the biggest winners in the portfolio. Maybe it doesn't. Either way, this video records exactly why I made the decision. No hindsight, no revisions. Just the reasoning, exactly as it existed on the day I bought the stock.
Before we wrap up, a few of you asked if I could show my entire portfolio at the end of each decision log. I think that's a great idea. One of the goals of this channel is complete transparency. So here's exactly what I'm holding today. As you can see, Microsoft is currently my largest position, at around 20% of my portfolio. There are also a few positions that are much smaller. That's intentional. For some of these companies like Constellation Energy, ticker symbol CEG, Broadcom, ticker symbol AVGO, Celsius, ticker symbol CEHO, etc., I've only built about 1/3 of my intended position. If the price drops and my investment thesis is still the same, I'll continue adding over time. If the stock keeps moving higher instead, I'm perfectly happy holding the position I already have. One more quick note. I recently transferred my portfolio into Robinhood. Because of that, some of the average cost numbers haven't carried over correctly yet. So for now, don't focus too much on the average price. The important part is seeing how my portfolio is allocated and how it evolves over time. I'll continue showing it at the end of future decision logs, so you can follow the journey along with me. If you enjoy this decision log series, consider subscribing. Every episode is a snapshot of my thinking on the day I invest. The market decides the outcome. My job is to make the right decision. I'll see you in the next decision log. Peace.